Hi guys, welcome back. The earnings season is still in full swing, and last week 3 companies that I have in my portfolio reported their latest numbers. Danaher reported on the 22nd and Texas Instruments as well as the utility provider NextEra Energy on the 23rd. And all 3 companies came in with quite positive results that mostly exceeded expectations. But that is not all. 2 of them even announced double-digit dividend growth during the last quarter. And that is huge for dividend investors like myself. So in this video, I will dive into the details of each report and give you my thoughts on them. So grab a coffee or tea or beer, I'm not judging, sit back and let's get going. First, let's start with Danaher. They reported net earnings of $1 billion, which resulted in $1.32 earnings per share or $1.88 in adjusted net earnings per share. The GAAP revenue decreased by 1% to $5.7 billion, but the non-GAAP revenue stayed flat on a year-over-year basis. This is not great, but basically it is in line with what they expected in the outlook last quarter. And actually, it was better than what most analysts expected. At least it resulted in positive EPS surprise of 14.4%, and the revenue was also 2.7% above the estimations. When we look at the year-over-year comparison, we see again that the revenue is down by 1%, the operating profit margins by 0.5% or 15 basis points, and the adjusted EPS by 2.1%. This is due to a bad performance in their biggest sector, the diagnostic sector, which is still struggling from a drop in demand for diagnostic testing after the pandemic, particularly for COVID-related tests. Their revenue in this sector declined by 3% and their margins by 3.4%. And the business in China was also struggling due to the implementation of volume-based pricing. This has led to substantial price cuts in the industry that will also affect these companies, including Danaher, in the next few years. Similar to this diagnostic sector, the business in the life science market did also decline by 3.5% and their margins by 2.2%. Only their biotech market saw a very nice growth of 6% with an improvement of the margins by also almost 6%. Overall, this led to a decline in operating cash flow of 25% and a free cash flow of 27%. So this all doesn't sound too great, right? But the company is still generating a ton of cash. When we look at the long-term trend for the cash flow, we see that there was extraordinary growth in the pandemic years 2020 to 2022. So this current decline is more of a return back to normal levels. Danaher themselves think that in the next quarter, their revenue will grow again with low single digits, and for the full year 2025, they also still expect a growth of 3% compared to 2024. So I am not concerned about the business, and even though this year's growth will not be too huge, compared to last year, it will be at least a return back to growth. I also still believe that their diversified business model will continue to generate a lot of cash and that Danaher is in a prime position to benefit from the increased needs for machines and tools for the healthcare market due to an ever-aging population and a general growth in this healthcare sector. And even though there are some uncertainties in their foreign operations that the tariffs have created, the company seems to think the same. Because in February, they announced to increase their dividends from $0.27 to $0.32. This is an increase of 18.5% compared to the last year. So they prove again that they fit perfectly in my dividend growth portfolio. And if you're concerned now that this might bring the dividends to unhealthy and unsustainable levels, there is no need to be. The cash flow payout ratio last year was at a very low 11.5%, so there is still a lot of room for further dividend increases before we reach any unhealthy levels. And despite the lower growth in the short run, I still think that Danaher will be an excellent investment in the long run. The next report was from Texas Instruments on the 23rd. And this is a position that I'm currently thinking of selling, so it was especially interesting for me to hear what they have to say. They reported revenues of $4 billion for the first quarter, which is an increase of 11% compared to the year prior and by still 2% compared to the last quarter. Their net income and EPS did also grow by 7% compared to the first quarter last year. This is not a bad start to the year and, honestly, much better than what I expected. It was also much better than what Wall Street expected, and they beat their EPS expectations by 16.7% and their revenue expectations by still 4%. This was mostly driven by a huge growth in the biggest segment, the analog segment, where the revenue increased by 13% and the operating profit even by 20%. This could easily compensate for the decline in the embedded processing segment that saw declining revenues of 1% and declining profits by 62%. This sounds very dramatic, but if you look at the total numbers, they are quite small. So it is not as bad as it seems. The same is also true for their smallest segment, the other segment. In the last quarter, they saw a strong recovery in the industrial market and overall strong growth in their industrial and automotive sectors. And Texas Instruments CEO Haviv Ilan said in the earnings call that even though they see a higher uncertainty for 2025, surprise, surprise, the semiconductor market seems to have bottomed out now. And historically speaking, in this stage of the cycle, inventories at their customer sites are usually very low across all end markets. So, relative to where we are today, it is important to have the capacity and inventory to cope with the rising demand. And TI is well positioned for both. They have invested heavily in their 300mm wafer production in the last years, which will lower their production costs and at the same time increase their capacity in the coming years. But these investments have also weighed on the free cash flow in the last years. We can see this very nicely in the long-term trend in my cash flow analysis dashboard in TradingView. The increased capex, here in dark blue, has pushed their free cash flow, the orange line here, down quite a bit. It also didn't help that their operating cash flow, the red bars, also went down largely in 2023. And because of this, the company didn't have too much cash available to return to their shareholders. So, share buybacks and dividend increases in the last 2 years were a bit lower than usual. But the majority of these investments are done now. For the next year, it is still not entirely certain at which level the capex will be. The company gives quite a big range between 2 billion and 5 billion here, with the 5 billions being on a similar level as the last years. But after that, the capex should go to more normal levels again and will be aligned with the revenue growth. This will free up some cash that the company can then use to reward their shareholders again. And because TI is well known for their investor-friendly policy, I would expect them to do just this. So, this report doesn't help me very much in deciding if I should sell them or not. It seems like they might be on the brink of an upcycle again, which would actually be a good opportunity to buy. And with the capex cycle coming to the end, they seem to be in a good position to reap in the benefits from their 300mm wafer production very soon. And even though they never mention any details on this, I'm also still pretty bullish on their GaN production line that is amazing for high voltage applications with higher switching frequency and better energy efficiencies that have huge advantages in applications like data centers. But on the other hand, I don't like where the embedded segment is going. These higher integrated devices could achieve better margins than their analog products, but Texas Instruments is still struggling in the sector against other players like Broadcom, NXP or Renesas. For the next quarter at least, they expect further revenue growth with a revenue increase to 4.17 to 4.5 billion with a similar EPS in the range of 1.21 to 1.47. So maybe I'll just keep them for a quarter or two more to see where this is going. Last but not least, let's also talk about the third company, NextEra Energy. And if you find this video interesting, please hit the like button or subscribe to the channel if you don't want to miss my next one. It also really makes my day. And as a thank you, I promise you to read all of your comments and to reply to as many as possible. Probably all of them because it's not that many. NextEra had also a pretty strong start in the year. They could grow their adjusted earnings and their adjusted EPS by 9% on a year-over-year basis. In terms of EPS, this beat the expectations by 1%. But the revenue was a bit lower than initially expected. Here, they were 5.8% below the forecast. If you've been following the company for a while, you probably know that NextEra Energy basically combines two companies under one roof. The one is Florida Light and Power, or FPL, and NextEra Energy Resources. And both of them are driving this performance and are also heavily investing in further growth. Energy Resources added 3.2 gigawatt of renewables and battery storage to their backlog, which makes this the 5th quarter in a row to add more than 3 gigawatt. With this growth, Energy Resources expects to operate a portfolio of over 70 gigawatt of generation and storage by 2027. To put this into context, today FPL and NextEra Resources together have a portfolio of 72 gigawatt. And FPL is not sleeping either. They also plan to invest $50 billion between 2025 and 2029 to add more than 25 gigawatts of energy generation and storage until 2034. In the last years, the majority of these investments was in renewables. But they are also operating a diverse portfolio that not only includes wind and solar farms with battery storage, but also natural gas plants and even a couple of nuclear power plants. And just a couple of weeks ago, John Ketchum, the CEO of NextEra, emphasized that they will need all different types of power if they want to meet the energy demand in the next years. Let's listen to what he said.
The key is that we're going to need it all. We're going to need renewables, we're going to need battery storage, we're going to need gas-fired generation, we're going to need nuclear. And why are we going to need it all? Because power demand is higher than it's ever been. We are anticipating the demand for power to increase sixfold over the next 20 years compared to the prior 20. We haven't seen this kind of demand for power since the Industrial Revolution. That's why NextEra plans to invest $120 billion of capital over the next 4 years, and it's going to come from all generation resources. But one of the points I want to make is that not all generation is created equally in terms of the ability to deliver it to market on a linear timeline. So, for example, renewables can be delivered right now. They're ready right now. They can accommodate that demand today. Gas-fired generation, for example, under the framework agreement we announced today, won't be ready until 2030 or beyond at scale, and then nuclear, beyond that.
So they expect the energy demand to increase sixfold over the next 20 years. That is an annual growth of almost 10% for 20 years. Not bad for a boring old utility company, right? And most of this growth, especially in the next years, will still come from renewables. This is because they are the fastest to deploy, while new gas plants will take at least 5 to 10 years to build, and new nuclear plants even more than 10 years. At the same time, renewables have the cost advantage compared to other forms of electricity. This results, for example, in the power bills from FPL being approximately 25% below the national average. With this outlook, NEE expects to grow the EPS with 6 to 8% per year until the end of 2027, and the operating cash flow with at least this growth rate. And best of all for dividend growth investors, they also plan to increase the dividend by around 10% per year until at least 2026. And that is also exactly what they did in February. Because there, they announced that the quarterly dividend will be $0.57 per share, which is 10% higher than last year. So overall, all three companies reported very decent numbers. And while Danaher might still have a weaker year this year, Texas Instruments reported much better numbers than what I would have expected. And I'm also pretty excited about the huge dividend increase for NextEra Energy and Danaher. And especially for Danaher, I would not have expected this increase to be at a whooping 18%. But in the end, this is exactly why I have them in my portfolio. So overall, I am pretty happy with these results. And last week, two of the most important semiconductor companies reported their earnings with ASML and TSMC. This was pretty interesting because the performance of these two companies provides valuable insights in the overall health of the semiconductor industry. If this is interesting for you, check out my video from last week right here, where I go over both of these reports in detail. That being said, thank you so much for watching, guys, and see you in the next video.